You are listening to The Vocal Technologist. Spoken tech for your ears.
If you are trying to figure out where the actual money is moving right now and what strategic moves are going to define finance in 2026, well, you are in exactly the right place.
Yeah, the material we've been looking at is just,
Yeah.
it's all over the map.
It really is. I mean, from the internal politics of these multi-billion-dollar private companies all the way to like the plumbing you need to finance tickets for space tourism.
Near orbit space tourism.
It really feels like one of those Founder Fridays. It's this moment where the established centuries-old rules, how assets are traded, how money moves, even who gets to be a bank,
Yeah.
are just being completely rewritten.
And rewritten by these incredibly fast-moving FinTech companies. They're not just innovating on the edges. They are, in some cases, building entirely parallel financial systems.
Exactly. So our mission today is to give you a shortcut through all this chaos. We're going to unpack three, I think, foundational and interconnected areas where this tech is making a massive mainstream leap. We've got the rise of event-based contracts as a real new asset class, the intense high-stakes race to define the world's digital payment rails, and maybe the most future-forward idea, the rise of autonomous agentic commerce.
When you look at all of that together, what's so striking is just the sheer velocity of the change.
Right.
It feels like a full-stack renovation of finance is happening all at once. You have these highly speculative assets, think event betting, moving into traditional trading infrastructure. And at the same time, you have digital currencies getting integrated directly into traditional banking systems. The lines are just blurring so fast.
And the rules are changing faster than the oversight can possibly keep up.
Absolutely.
Okay, so let's unpack this, and I think we have to start where all the capital is flowing, right?
Prediction markets.
Prediction markets. They have just rocketed from this, fringe curiosity for political scientists into a full-blown financial arms race.
Yeah.
And what's wild is, who is piling in?
It's the heavyweights. I mean, we're talking major global exchanges, ICE, CME, top sports leagues, massive private capital firms.
All right.
They are all making this foundational bet that event contracts, so contracts that pay out based on whether a specific thing happens.
Like an election outcome.
Exactly, an election, a crop yield, whatever, that this will become a brand new, globally traded asset class.
And the regulatory context here is so key. You've got players like Polymarket and Kalshi just racing to scale their operations right now. And it seems like they're benefiting from a, let's say, favorable regulatory window under the current administration. It lets them test and grow this market before, the heavy regulatory hammer potentially drops.
But that speed, that's where the friction comes from. The core regulatory concern is pretty straightforward. How do you stop what is essentially very sophisticated gambling from embedding itself deeper and deeper into everyday finance? If it grows too quickly, it just creates this massive oversight gap.
It raises a huge question, right? How are regulators supposed to manage a new asset class if its growth just sprints past their ability to build any kind of effective control?
They can't.
And here is where it gets really strategic, and this connects it all back to the mainstream consumer. Robinhood's enormous move.
Huge.
They didn't just partner. They acquired a 90% stake in LedgerX.
All for the infrastructure?
Exactly. To list and clear their own event-based contracts, this isn't an experiment for them. It's a full-on vertical integration play.
And their motivation is just crystal clear. You look at the numbers. Prediction trading is their fastest growing revenue line.
Is it really?
Oh, yeah. Their users have executed more than 9 billion contracts.
9 billion. That's a staggering volume.
It is. It shows this, instant, almost addictive engagement. So Robinhood is positioning itself to just outpace everyone by launching its own exchange for these contracts in 2026.
So they're using regulatory arbitrage, basically finding the fastest path to market to become an infrastructure provider, not just a brokerage app.
That's the move.
That is a perfect bridge. We're moving from speculation and regulatory arbitrage to the foundation, to digital money.
The rails.
Let's talk about defining the payment rails. We're seeing these huge data points that show stablecoins are finally successfully entering traditional finance and big tech infrastructure.
Yeah, and the traditional banks are making these cautious but necessary moves. You take U.S. Bank, their CEO admits that customer interest is, kind of muted right now.
I bet.
But they're still actively exploring how to safely issue programmable money on a public network like Stellar.
Right. They're working with the Stellar Development Foundation and PwC on that.
It just shows that traditional finance, they have to acknowledge that this public blockchain infrastructure has to be tested, even if they're not fully committed yet.
And then on the other side, you've got the disruptors building their own proprietary rails, Klarna.
Klarna is launching a fully dollar-backed stablecoin, Klarna USD. They see this digital token as just a dramatically faster and cheaper alternative to the slow, clunky traditional banking rails.
And what's so interesting is the infrastructure behind it.
Yeah.
It's running on Tempo. That's the blockchain built by two giants, Stripe and Paradigm.
So Klarna isn't just dipping a toe in. They're using a hyper-efficient private rail, and they're positioning Klarna USD as the foundation for their whole crypto and cross-border strategy.
This whole stablecoin push also reveals this incredible global reserve dynamic.
Yeah.
We have to talk about Tether.
We have to.
They have quietly become one of the world's largest non-central bank holders of physical gold.
The numbers are wild. Their recent buying spree added over 100 tons of bullion to their reserves.
100 tons. That volume accounts for nearly 2% of total global gold demand recently. That's significant.
Wait, but this raises an incredible question, doesn't it? If Tether, the ultimate digital asset issuer, is relying on these massive, centralized physical vaults full of a 4,000-year-old asset to back its token, doesn't that just fundamentally undermine the whole decentralized ethos of stablecoins?
It creates a fascinating paradox, right? The strategic play is to make tokenized gold mainstream. Give retail investors 24/7 blockchain-settled access.
But the centralization risk is it's undeniable. They're digitizing an ancient asset, but they haven't solved the concentration problem at all. They've just transferred it to a new centralized custodian.
And meanwhile, the formal regulators are circling, trying to impose some kind of order on this.
Of course they are.
Federal Reserve Governor Michelle Bowman is actively pushing for new guardrails for stablecoin issuers. She's coordinating with other agencies to craft capital and diversification standards.
And this is all mandated by the Genius Act, right?
Exactly. And for anyone who isn't familiar with that specific legislation, the Genius Act is key because it requires these issuers to maintain full, verifiable dollar reserves. It's forcing transparency and liquidity.
It's the government trying to slow the velocity down just enough to get a regulatory floor in place.
Right. And if we connect this whole reserve discussion to the bigger payments landscape, this stablecoin boom is happening while the ecosystem is kind of paradoxically fragmenting.
Yeah, for years, the industry was chasing this utopian vision of seamless global harmonization, through standards like ISO 2022.
That dream is dead.
That vision has collided so hard with geopolitical reality. You've got national security concerns, trade tensions, tech silos. They're all creating national systems, not seamless cross-border ones.
Fragmentation, not harmonization, is the reality right now.
And that directly increases the complexity and the cost for any bank trying to figure out its cross-border strategy.
Okay, so we've covered speculation, we've covered the foundational money, but what does all of this actually mean for how we buy things?
It means AI is getting a credit card.
AI is getting a credit card, and it is shopping on our behalf. This is the agentic commerce revolution, and it's not science fiction. It is here now.
It's really here.
We saw PayPal integrate instant in-chat checkout directly into Perplexity. I mean, think about that. You're on an AI answer engine, you ask it what to buy, and the answer immediately becomes a fully transactional storefront.
You go from discovery to purchase without ever leaving the chat window.
It's a huge turnkey path into this whole new model.
And it's not an isolated thing. The infrastructure is solidifying so quickly. Amazon and Visa are partnering to build developer tools specifically for creating these autonomous shopping agents.
They see where this is going. If AI is doing the buying, they have to standardize how that bot talks to retailers, logistics, and payments.
And critically, this is rolling out to massive marketplaces. ChatGPT's instant checkout feature, it's expanding to over 1 million Shopify merchants now, after its initial launch with Etsy, and it's all powered by the Agentic Commerce Protocol.
That's the open standard they co-developed with Stripe, right? It lets the AI agents securely coordinate purchases with, tokenized payment details.
Exactly.
And what really stands out here is the scope. The anecdote we saw shows the items being bought they're wildly high value.
It's not just books and groceries.
No. Luxury shopping is blending 5-figure handbags, even seats on those near-orbit space tourism flights, into the same digital checkout flow. It is literally scroll, tap, and pay, whether you're buying a $20 book or a $500,000 experience.
A shift in consumption that big requires a fundamental shift in how people plan for their future, which brings us to wealth management for the next generation.
Right.
We need financial solutions that directly address financial nihilism.
And by that, just to be clear, we mean that feeling of despair among younger generations.
Yeah.
This feeling that the traditional paths to wealth saving, retirement accounts, buying a home feel impossibly out of reach.
The cost of living, stagnant wages.
Exactly. So banks have to offer products that encourage long-term saving, but also acknowledge that current economic reality.
And the traditional players are starting to respond. Bank of America, for instance, they launched a digital system that converts 401k balances into structured retirement income.
It gives workers these really personalized projections, real-time recalibration. It's all about boosting confidence that their money will actually last.
And at the same time, the pure AI advisors are aggressively targeting that younger user base. Wealthfront is targeting a $2.05 billion valuation in its IPO.
Wow.
And they're leaning heavily into that AI-enhanced robo-advisor model that's focused squarely on millennials and Gen Z. It's sophisticated advice without the heavy fees of a human.
And even the back end for human advisors is being revolutionized. A startup called Nevis just secured $35 million.
And what do?
They automate the manual work, generating detailed meeting summaries, drafting follow-up emails, and eventually automating stuff like account openings.
So they're augmenting the human experts, not replacing them? Freeing them up for the complex stuff.
Exactly. Okay, so we've established the incredible speed of all these changes, from prediction markets to autonomous shopping. But speed demands security and really robust infrastructure.
It really does.
So in our final section, we need to look at what companies are doing under the hood to protect themselves and scale their operations. This is the critical, non-sexy layer of FinTech.
And critical defense is, it's not optional anymore. Not when AI-powered fraud is accelerating so dramatically. Online fraud jumped, 21% year over year?
21%.
You've got synthetic identities, sophisticated deepfakes everywhere, so companies need a true multi-layered defense.
Biometrics, behavioral analytics.
Right, which is how you hold and type on your phone.
Yeah.
And adaptive authentication. It's a strategic requirement to protect revenue and user trust, not just some compliance checkbox you tick.
And on the scaling side, infrastructure is just everything. Stripe is acquiring Metronome. They want to integrate usage-based billing directly with their core payments infrastructure. They're not just optimizing, they're building toward a standard of 5 nines of uptime.
And just to explain that simply for everyone, achieving 5 nines of uptime means your system is only down for about 5 minutes over an entire year.
For a global payments platform, that kind of stability is a massive strategic weapon. It's what allows all this agentic commerce to happen reliably.
And that relentless push for scaling and optimization, that's what drives the exponential VC success we see.
Yeah, that Boulderton Capital investment in Revolut. Their early £1.5 million seed investment delivered an estimated 2,050 times return.
It's an insane number, and it explains why capital is now pouring into these super specialized, under-modernized sectors.
Like health tech.
Oh, health tech is one of the biggest opportunities. Healthcare revenue cycle management, RCM, that's the whole process of managing patient billing and claims.
It's a mess.
It's a mess, and it's a massive, inefficient $300 billion opportunity for AI. RCM providers are seeing denial rates from insurers just skyrocket, and AI is the only way to process the data fast enough to keep up.
Finally, though, we have to touch on the regulatory friction that comes with all this disruption.
Always.
Stripe is facing intense pushback on its bid for a national trust bank charter. A leading public interest group is arguing this could let Stripe expand into banking services without meeting the traditional rigorous oversight.
It just blows that line between a tech platform and a federally supervised bank.
And we're also seeing geopolitical concerns pop up in the data integrity space. We saw those claims from Keith Rabois about AirWallex.
Right, suggesting that based on where its employees are and its legal obligations, there's a pathway for foreign governments to get access to sensitive U.S. company financial data.
So these geopolitical and regulatory hurdles, they aren't stopping innovation, but they are adding some necessary high-stakes friction to the system.
For sure.
Wow. We have covered a tremendous amount of ground today.
We really have.
Established banks like U.S. Bank, payment giants like Klarna and PayPal, disruptors like Robinhood. They're all moving at breakneck speed into new asset classes or building foundational infrastructure.
I think the key takeaway for you listening is that the future of finance is actively being built around 2 core connected components: First is autonomy AI agents shopping and making financial decisions for you.
Right.
And second is digitally native collateral, so
Yeah.
digital assets like stablecoins, which are increasingly backed by tangible things like physical gold, providing this whole new layer of trust.
That's absolutely right. And I think what we've explored today shows an industry that's simultaneously looking forward to these future trillion-dollar companies and also urgently looking back to make sure they are protected from increasingly sophisticated AI-fueled fraud. This whole dynamic, to me, this is the vocal technologist showing you the cutting edge of fintech.
It is.
So we'll leave you with this final thought. If AI agents are autonomously shopping and managing billions in value for consumers, and all these transactions are settled instantly with digital assets, how long is it until the primary consumer touchpoint is no longer the traditional bank, but the AI assistant itself?
And what is the real value of brand loyalty in an entirely agentic world?
We'll leave you to chew on that one. Until next time.
Spoken Tech for your ears.